How to select stocks for long-term investment. There are hundreds and thousands of ways to find stocks for long-term investment, but we will talk only about 7 most effective ways to find stocks for long-term investment. Rather, these are 7 rules which should be kept in mind while purchasing stocks for long-term investment. Rule number 1. Invest in stocks of that sector which you understand easily. It's like buying a product in the market. When you go to a shop, you only purchase products on which you have information or the products you know. Never buy the products you don't know or don't have any information on it. Similarly, you should never invest in stocks or sectors which you don't understand. Rule number 2. Buy companies with total debt to current asset ratio less than 1.10. It is important at all times to invest in companies with a low debt load, especially now with tight lending in a weak economy. Rule number 3. Find companies with current ratio less than 1.50. This is a common ratio provided by many investment services and is especially important now because you want to make sure the company has enough cash and other current assets to weather any further declines in the economy. The formula for current ratio is current asset divided by current liability. Rule number 4. Find companies with positive earnings per share growth during the past 5 years and with no earning deficits. Earnings need to be higher in most recent year than 5 years ago. Avoiding companies with earning deficits during the past 5 years will help you to stay clear out of high risk companies. Rule number 5. Invest in companies with a price earning per share PE ratio of 9.0 or less. Finding companies with low PE ratio usually eliminates high growth companies. Rule number 6. Find companies with price to book value ratio less than 1.20. PE ratios can sometimes be misleading. So, to assure ourselves, we need to find the price to book value ratios. Price to book value ratios are calculated by dividing the current price by the most recent book value per share for a company. Book value provides a good indication of underlying value of a company. Investing in stocks selling near or below their book value makes sense. And last but not the least, rule number 7. Invest in companies that are currently paying dividends. Investing in undervalued companies requires waiting for other investors to discover the bargains you have already found. Sometimes your wait period will be long and tedious, but if the company pays a decent dividend, you sit back and collect the dividends while you wait patiently for your stock to go from undervalued to overvalued.